So here's how I look at it to keep it simple. And that's one of the things with this. I always try to keep it as simple as possible. There's always a cost of money, right? So if you can reduce your cost to borrow your money, then do it, right? This comes down to your cars. This comes down to real estate. This comes down to any asset that you're looking to leverage your policy for, whether it's your business, equipment, anything of that nature, right? Like if I can go out and get a car loan at 1.9%, why am I going to take a policy loan for 5%? Why am I going to do even a cash value line of credit or a third party outside of that, the auto lender? Why would I pay more for the cost of that money? The answer is I wouldn't, right? Hey, what's going on, cash flow hackers? It's Chris with Life 180. And for this video, we're going to be talking about a pretty controversial and I think over-debated topic about direct versus non-direct recognition companies with mutually held whole life insurance companies. So what I'm going to do is I'm going to get into what is direct recognition, what is non-direct recognition, why does it matter, and ultimately, how can you make it not matter in your life, in your financial plan? Because I think, once again, this is one of the most overplayed, oversold conversations in the entire infinite banking / whole life insurance as an asset business. Essentially, what I want you to think about is the fact that direct recognition and non-direct recognition simply pertains philosophically and fundamentally how the interest crediting goes to your policy from the insurance carrier, right? So direct recognition is simply saying it has two different interest crediting strategies, right? So with a direct recognition company, it's saying that when you take a loan against your policy and you collateralize that policy for a loan, it's got one crediting rating, one interest crediting rating for the amount of money that you have policy loans out on, and it has another for the money that hasn't yet been collateralized. Conversely, non-direct recognition companies have one interest crediting rate, and it doesn't change regardless of if you have a loan against your policy or not. Now, this idea of non-direct recognition, and the idea that it has one interest crediting rate has led people to falsely believe that because of this reason, non-direct recognition companies are where it's at and that it's always better. Now, while I love working with some non-direct recognition companies, it is not just because of the sake that they're non-direct recognition. That's important to understand. And while it makes the non-direct recognition conversation leads for a great marketing pitch, the reality is nothing could be further from the truth from the perspective that, it's not always going to lead to better policy performance long term. In fact, it typically doesn't, right? And this is why Nelson Nash wrote in his book, when he wrote his book, the Infinite Banking book, he talked about primarily direct recognition companies, right? And here's why, because when you have a policy with a mutually held company, you share in the profits like you're a shareholder of a publicly traded company, right? So you always have to be thinking about the better good of the company and the profitability of the company. When you look at policy loans that are taken out of the company, you have to look, loans are assets on the books of the insurance company. So when the interest rate that you're paying is higher with a direct recognition company, right, and they credit the interest differently, which is what they do, you're actually helping the insurance company create more profit, right? And that profit typically gives a bump in the dividend rate potential, right? That's how it works. And because this is a long-term game, you're participating in that long-term dividend bump. And that's why a lot of times direct recognition companies typically have higher dividend rates than non-direct recognition companies. Now, with a non-direct company, if they are crediting a higher dividend rate than the loan rate that they're charging, the interest they're charging for the loan rate, that rate is actually needing to be subsidized by the company and the other policyholders, right? Because policyholders are effectively owners of the company. So at any time you have an interest rate that's lower than the dividend rate, there's a net cost to that. And it's going to long-term affect the dividend rate and the profitability of the company, which then in turn lowers the dividend rate. The bottom line is that whole life companies stopped allowing people, policyholders, to have positive built-in arbitrage into their whole life policies a long time ago. And even the non-direct recognition companies that say that they allow you to do that really only do it with a bit of smoke and mirrors. And the reality is, like I just said, over a prolonged period of time, it all evens out typically. And since this is a long-term strategy, you have to start with the end in mind. You have to be really intentional. And this long-term strategy is I always am hammering in that this is a long-term strategy. What happens long-term and not year in, year out matters. It's very similar to what I talk about when it comes to taxes. How much sense does it make to be worried about a tax deferral today if if it's just going to cost you more in taxes later, right? The difference between a tax deduction and a tax deferral are two completely different things. And understanding those two different concepts versus direct and non-direct recognition come into play. And at the end of the day, this is why I say that the direct versus non-direct recognition, conversation is the most overplayed conversation in the entire industry. So here's how I look at it to keep it simple. And that's one of the things with this. I always try to keep it as simple as possible. There's always a cost of money, right? So if you can reduce your cost to borrow your money, then do it, right? This comes down to your cars. This comes down to real estate. This comes down to any asset that you're looking to leverage your policy for, whether it's your business, equipment, anything of that nature, right? Like if I can go out and get a car loan at 1.9%, why am I going to take a policy loan for 5%? Why am I going to do even a cash value line of credit or a third party outside of that, the auto lender? Why would I pay more for the cost of that money? The answer is I wouldn't, right? The one thing I love about infinite banking and utilizing this system is because it sets in place a set of rules for you to know what you can buy, when you can buy it, what you should invest in, when you should invest in it, how you should invest in it. And then once you follow that set of rules and you stay within those guidelines and the guardrails, I'll call them bumpers on a bowling lane, right? Like when you stay inside those bumpers, then what happens is it gives you that set of rules to stay on the alley, and then you're in the game, right? Then you're going to hit the pins every single time, right? And when you do that, then it's just a matter of being more efficient. When you have these set of rules that are going to keep you on the lane, then it becomes a perspective of efficiency and getting better and making better financial more. But here's the problem that I see with most infinite banking practitioners is that, it's not the pure infinite banking thing to talk about, right? Like they're not big believers in using third-party lenders. In fact, they're kind of against it. And the reason I think it's important to understand that most practitioners believe that it doesn't make any sense to bring, like, why would you be doing infinite banking? Why would you be starting this banking and savings alternative inside of a whole life insurance policy to eliminate the bank's function in your life? My belief is that you're doing this because money has a cost and because you have the ability to increase the efficiency of your life and that you have the ability to build in positive arbitrage on a guaranteed basis, to build in that positive spread that will increase your financial efficiency. Think about it this way. If I could take and reduce a loan rate from 5% to 3% on a $200,000 loan, that's going to be worth potentially six figures over the period of my life for investing. Now, the only downside to using an outside bank is that there are going to be minimum interest payments that are required. The benefit to using a policy loan is while you pick up a higher interest rate, it's an unstructured loan, so you have complete control of it. Now, that's a good and a bad thing, right? Because I think that having required minimum interest payments is a very good thing because it forces you to be disciplined with your strategy. And whether you're investing for cash flow or whether you're buying a car or equipment or anything of that nature, it forces you to participate in the infinite banking system with the right principles in place. And if for some reason something happens to you and you need the flexibility, you can always shift the money back to the insurance company. Because remember, when you take a third-party line of credit, like a cash value line of credit through a bank, you're leveraging your whole life policy as collateralization, right? So you always have the ability to shift back the risk back to the insurance company and shift the loan back over to the insurance company by borrowing against the policy to pay back the line of credit that the policy is guaranteeing in the first place. But from a financial perspective, why would you do that too early? So the one thing that I have to say though, for some people, is that the downside for most cash value lines of credit and utilizing a third-party bank is that you do need to accumulate typically about $50,000 or more in your policy in order to be able to utilize it, the policy to collateralize a third-party line of credit, right? Now, this is one of the reasons that I love front-loading policies with a lot of money. Because think about it this way. If you had, let's say $50,000 sitting in an account and you could front load the policy with that $50,000 and then commit to say a $6,000 annual premium or $10,000 annual premium, that's going to get you immediately qualified to take advantage of a cash value line of credit year one and start leveraging a financial system that can build in positive arbitrage in your life that's going to give you more control, more guarantees, set you up for more opportunity, more protection. It's going to give you inflation hedges. It's going to give you all these other benefits. And at the end of the day, this is why I love to do this, because it's all about setting you up to be able to have a system that you understand all the moving parts and you can make decisions not from a, just I have to do it because I have to do it, but you literally understand all the different variables going into it so you can make a decision based on what is the most financially efficient thing for you to do. Period. I don't care what anybody else says. This is all about control and efficiency. And the more control you have, the more efficiency that you have. And I know that a lot of people think that by bringing in a third-party bank, you are giving up control. But the reality is you're not. You only give up control if you don't have the money to pay that bank back immediately. It's one of the things I talk about with a personal home. A lot of people think, like Dave Ramsey's of the world, teach your best bet is to pay off that house as fast as possible. Now, I'm in agreement with him that I want to make sure I have enough capital and enough money if I needed to write a check, I could pay that house off as fast as possible, because that's control, right? That's leverage, is by having that capital that I could just write that check and be done with it. But actually paying off my house is not the most efficient thing to do, especially in the world we're in today with low interest rate environments where I could guarantee earn a higher rate of return than the 3.5% mortgage that I'd be paying. In a world, where I get the tax benefits of having a house, the liability protection of having a mortgage on my house. If I have my house paid off, it's exposed to creditors, it's exposed to lawsuits, if you get in a car accident, anything like that. A lot of people don't think about a lot of the variables. Now, I have a video that I did, about a half-hour video simply on how to pay off your house, and the comparisons of a 15-year mortgage, a 30-year mortgage, paying it off, paying it cash, all these different variables and all the kind of moving parts and elements that people need to think about when it comes to paying off their house. But that's just something to be considering. But at the end of the day, here's the deal. This video is about direct versus non-direct recognition, and the bottom line that I look at is doesn't really matter. I would say your best bet is to find a policy that works for you, and to not leverage policy loans as the main source of leveraging the policy in the first place. I would say that your first objective is to get the policy to a place where you could leverage it and collateralize it against a third-party lender and utilize that third-party lending to create positive guaranteed arbitrage in the growth of your policy long-term. And when you do that, that's going to lead to hundreds of thousands of dollars, potentially more, depending on obviously the size of your policy, but at least tens of thousands of dollars more over your lifetime, to be able to get you where you want to go on a more predictable basis. So anyway, if you have any questions at all, leave comments in the comment section below. If you haven't already, hit the subscribe button, click that bell, that way you get notified every time I launch a new video. Until next video, have a blessed, inspirational day. We'll talk soon. See ya.